Last week, behind closed doors at the White House, one of the most powerful figures in the American oil industry looked straight at the President of the United States and used a word that should alarm anyone hoping to see cheaper fuel prices. That word was uninvestable. The chief executive of ExxonMobil, Darren Woods, sat across the table from Donald Trump after being asked to commit $100 billion to Venezuela's oil sector. His answer was not cautious diplomacy. It was a clear refusal, delivered with the calm language of corporate restraint. And this is why that moment matters. Venezuela holds 303 billion barrels of proven oil reserves. That is more than Saudi Arabia, more than any nation on the planet. Yet the man leading the largest publicly traded oil company in the world effectively told the president that the risk simply is not worth taking. Today, I'm going to walk you through what happened inside that room. You'll see why these companies are resisting, what the president is truly putting on the table, and why the distance between political ambition and economic reality has rarely been this wide. This story is not only about oil, it's about what happens when bold promises collide with basic math. Let's break it down. The president convened an urgent meeting at the White House. This was not a press event or a routine briefing. It was a direct closed-door conversation with the leaders of America's energy heavyweights. Sitting around the table were Darren Woods of ExxonMobil, Ryan Lance of ConocoPhillips, and Mark Nelson, vice chairman of Chevron. Executives from Spain's Repsol and Italy's Eni were also in attendance. The administration's proposal was simple on the surface. Venezuela's oil industry has collapsed. The country is now under interim leadership. The United States has effectively positioned itself to oversee Venezuelan oil operations. The request was for American companies to move fast and move big. Pour in $100 billion. Rebuild shattered infrastructure. Restart production. Unlock those enormous reserves. And in return, help bring down gas prices for American households. That was the vision laid out. What came back was not enthusiasm, but resistance. Darren Woods spoke first, and his words hit the room with the force of a blunt truth. He reminded everyone that Exxon's assets in Venezuela had been seized twice. Equipment, facilities, long-term investments, all taken by the state without compensation. Then came the word that now looms over every serious energy discussion in Washington: uninvestable. And it's important to grasp the weight of that term coming from someone like Woods. This is not a risk-averse executive. Exxon drills in ultra-deep waters, operates in politically unstable regions, and has worked in conflict zones across the globe. When the head of Exxon calls a country uninvestable, he is not exaggerating. He is reading numbers on a balance sheet that do not bend to hope or politics. And his view was not unique. Ryan Lance pointed out that his company is still owed nearly $10 billion from Venezuela due to earlier expropriations. Those funds were awarded by international arbitration courts, binding legal rulings that Venezuela has simply ignored. Exxon, through the same legal channels, is owed roughly $2 billion. So when the president asks these executives to inject new capital, he is effectively asking them to trust a country that still owes them a combined $12 billion. Look at this purely as a business decision. Would you lend more money to someone who already owes you a fortune and has shown no intention of repaying it? Would you deepen a partnership where trust has already been broken, not once, but twice? That is the equation these executives are facing. And at this moment, the numbers do not add up. To really understand why, we need to look at the broader context behind this situation. Venezuela's oil saga stands as one of the most devastating resource failures of the modern era. And once you understand this history, the hesitation from these companies starts to make complete sense. Back in the 1990s, Venezuela was producing 3.5 million barrels of oil every single day. It was an energy superpower. Foreign capital poured in. Infrastructure was modern. Skilled engineers and technical experts were everywhere. Then everything changed with the rise of Hugo Chavez. Under his leadership, Venezuela launched what it called a nationalization campaign. Foreign oil companies were given a stark choice: accept minority ownership under the state-run company PDVSA or walk away. Some firms chose to stay. Companies like Total, Chevron, Statoil, and BP agreed to smaller stakes and kept operating. Others refused. Exxon and ConocoPhillips would not accept conditions that stripped them of control over assets they had financed and built themselves. The response from Venezuela was swift and absolute. Refineries, pipelines, equipment, and facilities created with American money and expertise were seized almost overnight. The companies turned to international arbitration, and they won. ConocoPhillips was awarded $8.7 billion. Exxon was awarded $1.66 billion. Venezuela did not pay a single cent. More than a decade has passed, and those rulings remain unpaid to this day. Now shift to the present. What does Venezuela's oil industry actually look like right now? Production has fallen from 3.5 million barrels per day to roughly 1 million. That represents a 71% collapse in less than 3 decades. But the damage goes far beyond lower output. The physical system itself is deteriorating. Equipment has been stripped apart for spare pieces. Pipelines are rusting and leaking. Refineries are running at a fraction of their capacity when they run at all. And the people who know how to keep these complex operations alive, the engineers, technicians, and specialists, have largely fled the country. Venezuela's oil sector is not merely struggling, it is breaking down. Analysts at Rystad Energy have examined what recovery would realistically take. Just to raise production back to 2 million barrels per day, still far below its former peak, would require between $8 and $9 billion in fresh investment every single year for the foreseeable future. And that scenario assumes conditions that simply do not exist. It assumes political stability. It assumes legal protection for investors. It assumes a government that respects contracts. None of those boxes are currently checked. David Goldwyn, who spent years serving as the State Department's Special Envoy for International Energy Affairs, understands exactly how these investment decisions are made. His verdict on the president's $100 billion proposal was direct. He called it fantastical. Goldwyn explained that major oil companies will not commit even single-digit billions, let alone tens of billions, without 3 essentials: physical security for their people and equipment, legal certainty that their investments will be protected, and a fiscal framework that makes the economics viable. Venezuela offers none of these today. His estimate is that smaller independent firms might invest around $50 million each over the next year. That may help at the margins, but it is nowhere near the sweeping transformation being promised. So when you hear the figure of $100 billion, understand what it truly represents. It is not a serious financial forecast. It is a political number, designed to sound bold. Any real capital entering Venezuela, if it enters at all, will be only a small fraction of that amount. And this is where the story becomes far more complex, and where most coverage completely misses the point. Because the president is not simply asking companies to invest in Venezuela. What he is proposing goes far beyond a normal investment pitch. It is something much more extreme. The president suggested that American companies would not be dealing with Venezuela at all. During that meeting, he told the executives directly, and these words matter: "You're dealing with us. You're not dealing with Venezuela. We don't want you dealing with Venezuela." Pause for a moment and think about what that actually implies. The United States is asserting effective control over another country's oil resources, not through partnership, not through negotiations with a sovereign government, but through direct management. The administration has already taken control of Venezuelan oil tankers. It is setting up a system where Venezuelan crude is sold through channels run by American entities. The revenue from those sales is being placed into treasury accounts overseen by the United States. There is no modern precedent for this, and it opens a series of questions that no one seems able to answer clearly. Here is the first major problem. The president recently signed an executive order preventing United States courts from seizing Venezuelan oil revenues. His justification was that allowing such seizures could harm American foreign policy interests and international relations. Now look at this through the eyes of Exxon and ConocoPhillips. These companies spent years fighting their cases in international arbitration. They won. They relied on the expectation that American courts would help enforce those rulings by allowing the seizure of Venezuelan assets to recover what they are owed. With a single decision, that path has effectively been closed. So the same companies being asked to invest billions of dollars are now being told that they cannot collect the billions already owed to them. It is not hard to understand why the executives might struggle to interpret that message. Ryan Lance of ConocoPhillips addressed this contradiction directly. He argued that Venezuela's entire energy system would need to be rebuilt from the ground up, including PDVSA, the state-owned oil company. He stressed that the global banking sector would have to step in to restructure Venezuela's debt and supply billions in fresh financing. In simple terms, he was saying that serious investment is impossible until the entire structure is redesigned. That is not a project that can be completed in a single year. It is not even a 5-year effort. This would require deep institutional reform in a country that does not currently have an elected government, and that leads to the political uncertainty hanging over everything. Venezuela is now led by Delcy Rodriguez, who previously served as vice president under Nicolas Maduro. She is acting as an interim leader, yet there is no constitutional process in motion. There is no clear election timeline. There is no defined path forward. If you are an oil executive considering a 20-year commitment, which is standard for major energy projects, you need to know exactly who your counterpart will be. You need confidence that agreements signed today will still be honored 10 years from now. At the moment, no one can offer that guarantee. To understand how difficult this is, consider a historical comparison. After the invasion of Iraq, the United States made similar assurances. Iraqi oil revenues would pay for reconstruction. American forces would provide security. International oil companies were invited to invest. Even then, those companies moved cautiously. Despite direct military protection and full control on the ground, restoring oil production took more than a decade. And there is a crucial difference. Iraq's legal and institutional framework, while deeply flawed, was still more stable than what Venezuela presents today. Iraq had a functioning government, imperfect as it was. It had ministries, even if corruption was widespread. Venezuela, by contrast, has an interim leader, frozen financial accounts, broken institutions, and $12 billion in unpaid debts to the very companies now being asked to take the risk. The gap between what is being demanded and the reality on the ground is enormous. There is one notable exception to all this corporate doubt, and it deserves closer attention. Chevron never fully exited Venezuela. While other major players pulled out, Chevron stayed, operating joint ventures with PDVSA under special licenses issued by the United States government. They left their equipment in place. They preserved local relationships. They kept parts of the operational system alive. During the meeting, Chevron's vice chairman, Mark Nelson, presented the most optimistic outlook. He said Chevron could double production almost immediately and increase output by another 50% within roughly 18 to 24 months. But it's critical to understand what sits behind that statement. Chevron is playing a completely different game. They already have assets on the ground. They already have functioning operations. They are not starting from zero. Exxon and ConocoPhillips would be entering a country that forced them out, seized their property, and never paid compensation. They would have to rebuild everything from the ground up: physical infrastructure, workforce relationships, legal structures, security arrangements. Chevron can talk about rapid gains because they are already inside the building. Exxon and ConocoPhillips are standing outside a structure that once destroyed their previous investment and is now asking them to rebuild it with no insurance and no lease agreement. These are fundamentally different realities. Treating them as the same creates a false impression of what is actually achievable. Up to this point, the discussion has focused on governments and corporations. Now let's bring it down to the level that truly matters. How this clash between political ambition and economic reality affects real people. Start with American families. The president openly promised that investing in Venezuelan oil would translate into even lower energy prices for households across the United States. That was the pitch. That was the justification. Energy analysts are strongly pushing back on that claim. Experts at Rystad Energy have warned that Americans should not expect the situation in Venezuela to reduce oil prices anytime soon. And the reasoning is straightforward. Even under the most optimistic assumptions, maximum investment, flawless execution, and full political stability, meaningful increases in Venezuelan production would take years. The damage to infrastructure is simply too severe for quick solutions. Picture a typical American family spending around $400 each month on gasoline and energy. They hear promises of relief. They are told help is coming. But the timeline for Venezuelan oil to reach United States markets in meaningful volumes is not measured in months. It is measured in years. And that is only if everything goes perfectly. In the meantime, oil prices remain high. And the intense political focus on Venezuela may be drawing attention away from domestic energy policies that could have a more immediate impact. When leaders promise future relief without acknowledging realistic timelines, They create expectations that cannot be met. That disappointment slowly erodes trust in the entire political system. Now consider American workers. During these discussions, the Treasury Secretary made an observation that caught attention. He suggested the administration might lean more heavily on smaller independent oil companies rather than the large multinational firms. He described it this way. The major oil companies move slowly. They answer to boards. They are not interested. Meanwhile, independent operators and individual wildcatters are calling nonstop. They want to be in Venezuela immediately. On the surface, this points to potential job opportunities for experienced oil field workers willing to operate abroad. But it is important to be honest about what high risk really means. Venezuela has suffered decades of institutional breakdown. Security conditions are unpredictable. Political violence remains a real possibility. People working in these conditions face dangers that simply do not exist in places like Texas or North Dakota. Yes, international assignments in unstable regions often come with higher pay, but the risks rise just as sharply. Personal safety, family stability, long-term career security, all of it is on the line. Anyone considering these roles needs to go in with full awareness, eyes open, no illusions. For smaller independent oil companies, the calculation looks very different than it does for the giants. Bill Armstrong, who runs an independent drilling business, attended the White House meeting and spoke with genuine excitement. He said his company is ready to move into Venezuela, calling it prime real estate in energy terms. From a geological standpoint, he's not wrong. Venezuela's oil reserves are remarkable, but smaller companies operate on far thinner margins. They do not have the financial shock absorbers that global majors rely on. When a company like Exxon loses $2 billion, it stings, but the firm survives. When a $50 million independent loses its entire investment, that can mean the end of the business. This creates a very real possibility. Smaller, more enthusiastic firms may rush into Venezuela, only to encounter the same legal and political barriers that have kept the majors away. Some might manage to succeed. Others could lose everything. The risk versus reward equation is different for these players, but the danger is still substantial. For the major corporations, restraint is driven by fiduciary responsibility. Exxon announced it would send a technical team to Venezuela to evaluate conditions, but made no financial commitments whatsoever. ConocoPhillips publicly praised the administration's efforts, while stressing that deep legal reforms would be required before any serious investment could happen. Behind these companies stand institutional investors, pension funds, mutual funds, shareholders whose capital must be protected by law. These entities cannot approve high-risk ventures in unstable environments without exhaustive due diligence. Financial markets have echoed this caution. After the White House meeting, energy stocks remained largely flat. Investors are not pricing in a surge of capital flowing into Venezuela anytime soon. And this is where the broader impact reaches everyone. When major investment decisions are postponed and political uncertainty lingers, oil companies cannot make long-term supply commitments. They cannot plan expansions. They cannot lock in production targets. That uncertainty tightens global energy markets, and tighter markets translate into higher prices. The irony is striking. The political instability surrounding Venezuela, the very problem the administration is trying to solve, may itself be helping keep energy prices elevated. So what is likely to happen next? I want to be careful here. These are scenarios based on current evidence, not predictions I would stake my savings on. In the near future, expect ongoing negotiations between the administration and oil companies. The White House needs to demonstrate momentum. The companies need to appear cooperative while avoiding binding commitments. Smaller independent firms will likely announce preliminary agreements to conduct technical evaluations inside Venezuela. Those announcements will generate headlines. But the actual money deployed will be modest. Millions, not billions. Chevron will likely report production increases from its existing operations. Mark Nelson's suggestion of doubling output may be optimistic, but some growth from Chevron's current base is realistic. What you should not expect to see is large-scale capital commitments from Exxon, Shell, or any of the other supermajors. The conditions they have clearly laid out, legal certainty, enforceable contracts, and resolution of past debts, simply do not exist today, and they cannot be created overnight. Legal challenges to the president's executive order restricting the seizure of Venezuelan oil revenues are already beginning to move through the federal court system. ConocoPhillips and Exxon hold federal judgments granting them the right to collect what they are owed. The question now is whether the executive branch can simply declare those judgments unenforceable. Constitutional scholars warn that this raises serious separation of powers concerns. Traditionally, it is the courts, not the president, that decide how and when legal judgments are enforced. If this dispute moves forward, the litigation could drag on for years, and with every passing day, uncertainty deepens. For American consumers, the takeaway is simple and sobering. Venezuelan oil will not meaningfully lower gas prices anytime soon. The infrastructure damage is too extensive, the political barriers are too high, and the scale of investment required is far too large for quick solutions. Looking further ahead, two broad paths appear possible. In the first, the interim government manages to stabilize the country. Legal reforms demanded by oil companies slowly begin to emerge. Initial investment agreements are announced, loaded with safeguards and phased funding. Over 3 to 5 years, production gradually rises, and Venezuela eventually re-enters the global oil market as a serious producer. Even in this best-case scenario, the timeline stretches across years before any noticeable effect on global energy prices. The second path is darker. Political instability persists, violence increases, legal rules remain murky, major companies stay away indefinitely, smaller independent firms that rushed in suffer losses, and Venezuela's oil industry continues its long decline, despite sitting atop the largest reserves on Earth. The most realistic outcome likely falls somewhere between these extremes. Limited investment from smaller players, incremental gains in production, perhaps rising from around 1 million barrels per day to 1.2 or 1.3 million. Helpful at the margins, but nowhere near transformative. The major corporations will continue to observe from a distance. They have been burned before. They remember it well. And their shareholders expect caution, not political compliance. Political reactions will follow familiar patterns. Republican lawmakers will applaud decisive action. Democratic critics will challenge the legal foundation and question promises of cheaper gasoline. Senator Chris Coons summarized the skeptical view bluntly. Military or political intervention does not magically undo decades of infrastructure decay and institutional collapse. He's right. This situation is far more complex than the administration is willing to admit. And no amount of political determination can override the basic arithmetic of rebuilding a collapsed industry inside an unstable state. Let's pull all of this together with a few key takeaways. First, the president is asking for $100 billion in oil investment in Venezuela. The chief executive of the largest oil company in the United States sat inside the White House and labeled that country uninvestable. That single word, coming from someone bound by fiduciary duty, someone who operates in some of the most difficult environments on the planet, reveals more about the true risk calculation than any political speech ever could. Venezuela still owes American companies roughly $12 billion in unpaid arbitration awards. Requesting new investment before settling old debts violates the most basic principles of business. Second, Venezuela holds the largest proven oil reserves in the world, yet today it produces less than 1% of global supply. Output has fallen by more than 70% from its peak. The infrastructure has fallen apart. The expertise that once kept the system running has left the country. Estimates point to $8 to $9 billion every single year, for many years, just to restore a portion of lost capacity. That $100 billion figure is not bold. It is detached from operational reality. Political ambition cannot rebuild rusted pipelines or retrain engineers who are long gone. Third, American consumers should not expect Venezuelan oil to bring lower gas prices anytime soon. This is not pessimism. It is simple arithmetic. Even in the most optimistic scenarios, meaningful production growth takes years. The promises being made today are creating expectations that no realistic timeline can satisfy. And when that relief fails to appear, frustration is inevitable. The deeper lesson here goes far beyond Venezuela. Political will, even when backed by military power, even when backed by seized assets and controlled revenues, cannot overpower economic fundamentals. When corporations with legal obligations to protect shareholder capital refuse to invest, that decision speaks louder than any speech or press conference. Markets do not respond to rhetoric. They respond to risk and return. And right now, the risks in Venezuela vastly outweigh the potential rewards. That is the reality as it stands. I'm genuinely curious what you think about this, not the politics. Everyone has political opinions. I want your view on the economics. Do you believe any major oil company will commit serious capital to Venezuela within the next 12 months? Or are we facing years of cautious waiting while promises are made and markets remain unconvinced? If you work in the energy sector, or if you've operated in politically unstable environments, your insight would add real value here. Share your thoughts in the comments. And for everyone watching, this gap between what politicians promise and what markets actually deliver shows up again and again across economic news. If you want clear analysis that cuts through the noise and explains how these situations really work, subscribe to this channel and stay with us. This story is far from over. Developments will continue, and when there's something that truly matters, you'll hear about it here. Thank you for watching. I'll see you next time.